Hello everyone, Tomo from Market Zone here with a quick update on what's going on right now in financial markets a day before FOMC. Hey guys, what's up? Tomo here again. Thank you for watching this video. Thank you for being a part of the zone. Don't forget to subscribe to this channel if you haven't already. Stay tuned with the Market Zone with all the analysis, trading ideas, and the interesting content that I'm providing. As always, the purpose of this video is to update you on what happened since I posted the weekly market analysis, the free newsletter that I post each Sunday. That if you haven't read already, you can check it out at themarketzone.net, and also to subscribe to get for free the newsletter each Sunday to your email boxes. I want to start this video with the dollar index. That's DXY's daily chart that you see here. The dollar index hasn't moved more than $0.50, that's the trading range that you're seeing here, for a whole 7 days since the French election. Now that's amazing considering the amount of data and economic events that we had last week and the amount of data and economic events that we are heading towards this week. That makes me wonder, how will the dollar index react to the Fed announcement tomorrow, when the Fed will announce that they will keep rates unchanged, of course, but what will be their forward guidance towards next Fed meeting on June. Technically, what we are seeing right now is a consolidation range between the trend line, this trend line that you see here, and the 200 days MA line. If the dollar index will continue lower, it will probably reach towards the harmonic support zone that I mentioned in the weekly markets analysis this week, near 98, 97.5. And if DXY will close back up above the 200 days MA line, it will probably retest the 100 psychological price zone as resistance. What does it mean for EURUSD? EURUSD is making another attempt to break the downtrend line that you see here. If dollar index will break below its uptrend line, EURUSD will probably continue north towards 1.13, maybe 1.14. That's the next weekly target zones based on the weekly chart analysis. You see, we have a weekly resistance zone near 1.14. If the dollar index will stay above its uptrend line, maybe we will see EURUSD retesting the 200 days MA line as support. That's the projection in case of the dollar index will get boosted by the Fed. I want to jump for a second to stocks. This is the S&P, SPX daily chart, and what we are seeing is a consolidation inside the PRZ of a bearish Gartley. That's the Gartley that I mentioned in this week's newsletter. We have two potential scenarios here: a breakout to the upside, continuation of the bullish trend, or a pullback towards the 50 days MA line, the fast MA line, and maybe even towards this uptrend line that you see here. For those of you who aren't familiar with harmonic trading and want to trade this bearish Gartley on SPX, the trading rules suggest to place a stop loss above X. As you can see, X comes right at 2400 psychological level. In such cases, I usually use some sort of a buffer above the 2400, above the psychological level, to make sure that I won't get spiked out. So if you can afford it, use a buffer. And the first target zone is the 38.2 Fibonacci level that you can see here. It comes pretty much near the 50 days MA line and the fast MA line that should act as support. So that makes 2370 strong support zone. If you're looking to buy the dip or something, 2370 could be interesting price zone for you. First target zone of the bearish Gartley, and also a support zone based on MA lines and Fibonacci's. The secondary target zone for the bearish Gartley is the 618 Fibonacci that comes pretty much near 2350. So bearish Gartley, stop loss above X, target at 38.2 Fibonacci and 618 Fibonacci. The thing that might indicate we are heading for a short-term pullback in stocks rather than extension of a rally is the fact that XLF, that's the financial sector ETF, and this is the weekly chart, hasn't joined the latest party in stocks. It didn't join the rally, and instead it respected the bearish grab that I mentioned in one of my latest analysis, in one of my latest newsletters. 25 was a potential sell zone, and as you can see, XLF respected this price zone and closed below its fast MA line, the weekly fast MA line, with a bearish pin bar that we got last week. So that's an interesting scenario that you might want to watch if you are trading stocks, holding bullish positions, or looking for bearish opportunities. Watch XLF near 25 inside the PRZ of this weekly crab pattern. Another chart that I mentioned in the weekly newsletter is GLD. This is the ETF that follows gold prices, that as you can see right now, the price is trading below its 200 days MA line. That's a support zone that I mentioned in the weekly newsletter. Yesterday was a bad day for gold, and today it tried to recover but stayed below its 200 days MA line. That's a bearish sign. More important, it's this trend line. Pay attention to this trend line. Only a close back up above it will trigger the bull scenario that I mentioned, that GLD will continue north towards the PRZ of this bearish Gartley. Right now, gold is still below its 200 days MA line, and if we will zoom out to the weekly chart, we can see that gold is trading around its 50 weeks MA line that currently acts as resistance, and the nearest support line is the 200 weeks MA line. That's a strong support line for gold, and the fast MA line that both come around 118. So if you are looking at gold as a longer term trading opportunity, or maybe investing, you should extend the support zone all the way down to 118, maybe even 117, and if you can afford it with your risk management rules. So this is gold. Currently 50 weeks MA line holds as resistance, and the nearest support is the 200 weeks MA line, the fast MA line, near 118. The last chart I want to cover in this video is oil. This is crude oil daily chart, and despite the fact that it wasn't mentioned in the weekly markets analysis this week, if you've been following me on social media, whether it's the Zones Trader on Instagram or Market Zone on Snapchat, you've probably seen this chart already. Oil was rejected today by its 200 days MA line that acted as resistance following yesterday's close, that closed below the 200 days MA line and turned it to resistance. That's why oil was rejected by the 200 days MA line, and more importantly closed below its trend line, its uptrend line that I mentioned last week. This is the last line of defense for oil's bulls. The pressure is being built up on oil as we approach OPEC meeting, with more talks about potential production cuts, and also the global tension, US, North Korea, Venezuela taking its toll on oil. As you can see, last week oil bounced from this trend line. Today didn't happen, but I work according to a weekly close. So till the end of the week, monitor this trend line, monitor the 200 days MA line. A close below them will be a bearish sign for oil towards next week. Close above them will keep oil alive towards OPEC meeting. That's it for this week's weekly market analysis video. I hope you liked it. If you do, please share it, and don't forget to subscribe to this channel, activate notifications so you won't miss the next video that I'm posting. And if you haven't subscribed already to the free newsletter, go do it now at www.themarketzone.net. Go to the services tab, go to free newsletter, just place your email address and you will get it each Sunday to your emails. Thank you very much.